Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. And today we're going to answer the question, do I really have to pay premiums my entire life?
I'm going to give you the short answer now, and it's no, you don't. But we're going to explain why you're going to want to.
In addition, today what we're going to talk about is really just the three types of policies that are out there. We're going to talk about Anthony's plan, how he intends to pay premiums, and it may not be the same way that you plan on paying premiums throughout your lifetime. And if you do want to stop paying premiums, we're going to give you the 4 or 5 options that are available to you. Enjoy this episode.
Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Before we get started, I just want to give a shout out to Vincent for giving us a 5-star review on the podcast, and he ended it saying, "There's no fluff or frills, just good, honest content. Comedy is a plus as well."
He's talking to me on the comedy part.
We'll see.
Thanks, Vincent. All right, let's get started with today. Today, let's start with discussing the 3 types of policies that are available to somebody. Anthony, what's the first one we're going to discuss?
First one we call it is the one and done policy.
Single pay. What's a pro? What's the advantage of a single pay?
The advantage of this is that we're going to have high early cash value. Also, this is great when you have windfalls or like a one-time event, right? And another pro is no ongoing premiums are required. Hence, we call it the one and done. But there's pros and cons to everything, Cam. So what's the Cam on this type of design?
The Cam or the con? The con on this type of a design would be that, like you just said, is maybe a pro, is that you can't put any more contributions into it. And most of the time, our clients are looking to continually make contributions. This is the savings vehicle that they've decided to choose to move forward. So I usually put that as a con. We cannot put additional funds into that type of policy. All right, Anthony, let's look at the second option that we have for policies. What would that be?
Well, we call them short pay.
Okay.
Meaning that we pay premiums for a shorter period of time. And typically that's as low as 10 years, could be 20, or it could be till a certain age, like you are 65. And really what the pro is on this, or what most people perceive the pro is, that you don't have to pay premiums.
Yeah.
To us, that's a negative, right? Because our premiums a deposit or are they a payment, right? And we actually did a whole podcast on that, and we'll put that link to that in the show notes. But our view is we want to pay premiums, and these short pays limit the amount that we can put in. But so Cam, what are some of the cons of these short pays?
The con with the short pay is the fact that you have very little flexibility kind of moving forward. Again, you're limiting your ability to put dollars into that policy. And you know what? I don't think anybody knows what year 11 is going to look like, let alone year 20 or 21. And so when somebody starts out with one of those policies on a short pay, is you're really limiting your options. I've never put in a short pay in force. Have you, Anthony?
I have, but it was a specific situation.
Okay.
Right?
Yeah, and I agree. And what ends up happening is year 11, somebody's got more money that they need to put somewhere. And if you look at having the opportunity or the ability to put that money in cash value in a policy, that's the best place for it. And if we are using a short pay policy, you cannot add any more dollars into that policy after year 11. So very limited on what you can do.
You know, and I've seen it, and we've run the math, and we look at efficiency or rates of return. Those shorter pays can be more efficient in the long run. But the problem is, just like you said, all right, you do a short pay to 10, right? So that looks efficient. What are you going to do year 11? You have more money. Oh, so you're going to do another short pay?
Yeah.
And then you start stacking those. I mean, the rate of return might look better, but like we constantly say, it's not about rates, it's about volume. How much dollars are we going to have at the end of the day?
Yep. Awesome. Let's look at the third option, Anthony. What is the third option for people that are out there? We just discussed a single pay, which is a one-time payment. We just discussed short pay. And obviously, what is the third option?
Just like we were just saying, you can pay premiums as long as you want. So let me repeat that. You can pay them as long as you want. So even though it's scheduled till you're 100 or 121, you can turn them off at any time. And I know you're going to explain that, but that is one of the positives. Also, I mean, I know we don't talk much about death benefit, but laying these all out, we're going to have more death benefit of these policies, and we have some more flexibility in the design as well.
Yeah, the downside to a long pay is that it does typically have a little slower start. And so when you hear us talk and say, hey, the downside to IBC is you're going to have a slow start, that's what we're referring to is we have a preference for keeping our options available to us. So if we can pay to age 100, great. That's how we like to set them up. And then if we need to scale it back at any point, we can, which is what we're going to touch on here in a minute. So long pays, right, are great, but they do have a slow start. So, Anthony, your perspective, I think you touched on it just a little bit, but if you could, your perspective on how long you want to pay premiums is typically a little bit different, I would say, than most people when they're approaching or viewing a premium for their insurance policies. If you could, share with our listeners kind of the way that you approach it, and then I'll kind of fill in on the back end on what most people think.
Perfect. What my plan is, I want to pay premiums as long as I can. Right, I do have an abundant mindset. I'm anticipating of continuing to work, continuing to have these assets that are making passive income. And ideally what my goal is that by leveraging my policy, I'm going to be able to create more and more passive income. So I'm going to need a place to put it. And the best place to put it is going to be inside the policy. And I know potentially right now, most of our clients, they don't really care about the death benefit, but that's because you're in your working years, right? You're maybe in your 20s, 30s, or 60s. But when you're in your 70s, 80s, like kind of your goals are changing. You start thinking more of the legacy and helping the next generation. So that's what I'm hoping. That's what I'm hoping, and that's what I intend that will happen. But again, nobody knows what's going to happen, so we need to have options. So Cameron, why don't you talk about what are some of those options if we don't want to pay premiums the rest of our life?
Sure. And Anthony, right, what you just stated was your plan is to continue to pay premiums as long as you can. And what I would say is I don't think that most people approach IBC, at least initially, and approach the policy with that assumption that I'm going to pay it forever. And so usually when somebody's asking, hey, do I have to pay this premium as long as you want? The answer is yes, you can, but you don't have to. And so typically what we're going to do is we're going to go through now and highlight some of the options that are available to somebody just to make sure that they know that they're available to them if and when they ever want to shut premiums off. So if somebody calls us up and they say, hey, listen, I do want to shut premiums off, or I'm not able to pay a premium this year, one of the first things that we look at is reducing the paid up additions rider. So as a reminder, on a properly structured whole life policy, there's two parts to it. There's going to be the base premium, and then there's going to be the PUA. The base premium is really something that is required by the insurance company to be paid every year. And we do have some options for that, which we're going to discuss in a second. But that PUA rider is optional. Every single year, you have the option of fully funding that, partially funding that, or just not funding it at all. And so the first thing that we're going to ask somebody is, hey, or give them the option is, hey, we don't need to pay the full premium. We can remove that PUA rider off of there. Right? Anthony, what would be the second one?
Well, I could say if we can't, a lot of it's going to go to, is this a temporary problem or a permanent problem, right? If it's temporary, then we need a temporary solution, right? And if it's permanent, we need a permanent solution. So we're kind of right now on the temporary. So
good point. Yep.
Another option is if we can't temporarily make the premiums, we can take loans to pay the premiums. And now that loan is there is going to be interest due.
Yep.
But remember, it's a loan against your policy, not from your policy. So your policy is continuing to compound. And probably more importantly, you have the ability to go back and pay that loan in the future. So when you get back on your feet, we've created a window or a space for you to repay those premiums that you skipped. And remember, we never broke the compound interest curve. So even though you might have paid that premium back, say, over 5 years, it's the same thing as if you had paid it on the date that it was due.
Great point, Anthony. One thing that I will typically tell somebody is a lot of times, at least if I look back over the years that I've had my policies, is, being an investor, business owner, right, is not every time a premium notice has shown up has my bank account, right, been congruent with that notice. And so I've used the APL feature to pay for that premium, and then what happens is just in the next month or 2 months or whatever it is I'll just catch up. And so
what's the APL feature?
APL is that automatic premium loan, and so like you stated, they're going to use the cash value to pay either that base premium and or the full premium on that policy for that year. And that brings me to what would be the third option for somebody is the APL, right, which is option number 2, is where you take a loan, you exercise a loan on that cash value. The third option would be actually to surrender a portion of your cash value to pay that year's premiums. And to remind you guys what a surrender is, that's where we actually say, hey, give me the cash value from my policy. So you're taking it out of your policy, your cash value is permanently going to drop by that amount, and then you turn around and you use that to pay the premium. And so there's no loan features, there's no interest that's accruing, there's nothing like that. It is certainly an option that somebody could use.
And so that is an example of a permanent solution.
Mm-hmm.
But as I had mentioned of using policy loans to pay premiums, that's temporary. So, but a lot of times we don't know if the problem's temporary or permanent. So let's start with a temporary solution, aka taking loans to pay the premiums. And if that turns to be permanent, then we can do like just what you talked about. We can call up the insurance company and say, hey, that loan that we took to pay the premiums, what, I want you to write that off. They take money from the cash value and pay that off. So that can turn that temporary solution into a permanent one.
Yeah. Anthony, what's one more? We got number 4. Let's just recap real quick. First one we talked about was reduce or stop our PUA premiums. We have the automatic premium loan feature. We have a surrender option. And then what's this fourth one?
Don't forget, we're getting dividends.
Ooh, good
right?
point.
Companies we use are mutual, meaning they're owned mutually by the policyholders. They're going to share the profits via dividends. Now, we typically like to kind of call it like reinvesting, where we put it back in the policy for a paid-up addition, but you don't have to do that.
Mm-hmm. You
can use that to lower or to pay your premiums, or you could even use that to pay down loans as well.
Absolutely. You know who doesn't have dividends? IULs. Sorry, I just had to throw that in there. Yeah. All right, so 6th option that we're going to discuss today is, again, Anthony's kind of classified these temporary, permanent. This is the most permanent one that you can choose, and this is what a reduced paid up option is. And essentially what you're doing is you're calling up the insurance company and you're saying, I don't want to pay any more premiums at all moving forward. And so you're shutting down, you're turning off the ability for you to pay premiums. And what you're going to find if you look at what happens when you do that is a reduced paid up can affect 2 things. It can affect your cash value and or your death benefit. If you go in there and you look at kind of how this affects it is your cash value actually really isn't affected by a reduced paid up. Mm-hmm. It continues to grow, compound, and accumulate inside of your policy. But a reduced paid up will, in fact, affect your death benefit. And when you see that reduced paid up, when you exercise it, the reason they call it a reduced paid up is because they are reducing the amount of death benefit down to the paid up portion. So you do see a pretty significant, doesn't have to be significant depending on the year you do it, but there will be a drop in death benefit. And then what happens, it'll start to accumulate after that. So no premiums are needed, but it's a great way to kind of shut off premiums. And mentally, that's typically the exercise that I kind of have clients, and I'll show them what a reduced paid up looks like when we assume, hey, we're going to retire at age 65. We'll kind of go through those options for them. But
yeah, and the reduced paid up, again, it's a permanent permanent solution, so we have to be careful about it. You can literally do that at any year, right? However, if you do it before you're 7, it automatically becomes a mech. So that is something that you have to be mindful of. And we're not going to get the details into it here, but let's say something happened and you couldn't pay the premiums for year 6 or 7. There's some ways that we can do it so we can turn into a reduced paid up and not being a mech, but that's something we'd have to work together to discuss.
Mm-hmm. Anthony, last one. Touch on this one, not to distract anybody, but what's one option that we could do if we have a policy that we want to get rid of or reduce payments in some way?
This to me is the last resort.
Absolutely.
Rarely have I recommended it, and that is you can sell it, right? This is a personal asset of yours, so you can sell it. You know what? One thing we didn't discuss before that. You could surrender it, right? You could go to the insurance company. They cut you a check for your cash value, just like that.
Yeah.
Right. But if you sell it, an investor is going to pay more than what the insurance company would pay for. But now you do got to live with the fact that somebody in there is going to profit upon your demise. But that is an option.
Absolutely. Awesome. So what we just went through was really the options that you guys would have if and when you ever wanted to shut premiums off or reduce them. I'm going to run through them real quick one more time. 1 is to reduce or stop your PUA premiums. 2 would be an automatic premium loan. 3 would be to surrender cash value to pay for the premiums, use dividends to offset the premiums. 6 would be a reduced paid up option. And then 7 is going to be the option to sell it.
Mm-hmm.
Awesome. Anthony, what else you got to add here before we wrap this up?
Well, let's talk about what the retirement looks like.
Okay.
Right? Most of the time, people are paying their premiums typically out of earned income or cash flow, right? And when we work less, I mean, we're not big fans of just totally retiring.
Mm-hmm.
But ideally, we want to find a job or a business or some investments that we can manage so we can still be actively mentally challenging ourselves. But when that happens, let's say that we aren't working as much, or maybe we don't have that cash flow each month or each year to pay the premiums. Well, when we're in that more retirement mode, our mindset's changing, right? Because now we're not making any more money. It's the money that we do have. We got to make sure that we're very good stewards of it. And our tolerance for risk is typically going to go down, and we're looking for more security and certainty. So odds are you're going to have some assets that are volatile, maybe a little more risky than you want, or maybe you have some properties or a business that you don't want to manage anymore, and you sell those. That's going to give you a windfall of cash. You're going to need a place to put it.
Mm-hmm.
So what you could do, you can use that to pay premiums. So ideally what I recommend people do is let's pay premiums out of pocket as long as we can. And then when we can't, are there assets that we want to be more safe and secure? Let's liquidate those and use those for premiums. And then at that point, we could maybe look at a reduced paid up, but I will tell you what to dive a little deeper into kind of what my plan is. I won't do a reduced paid up because for one, I'm expecting I'm always going to have some cash or I'm going to have some windfalls. And, let's talk about your favorite movie, Cameron, or your second favorite movie, like The Notebook, which we all know. And your other favorite movie is Zohan.
Mm-hmm. It's a good one. You should watch it.
Don't mess with the Zohan. But back to The Notebook, I'm going to spoil it if you haven't seen it, but they die cuddling at the end. I mean, it's touching. I ain't going to lie, I cried. Okay? Odds are that's not going to happen. So, like what I've done, I have policies on me and policies on my wife. And if I can't pay the premiums out of pocket, I'm going to pay them through a loan.
Mm-hmm.
And the reason being is odds are somebody's going to go first. And odds are it's probably going to be me.
Yeah.
Right? So if my wife has her policy and we've used loans either to pay the premiums or to live on the cash flow, that means she's got a place to put some money. So when she gets this windfall, hopefully it's a long time from now.
Yeah.
Right? And she's not going to want to go buy real estate or do some investments. She's going to want her money to be safe. She can take that money and put it into a policy loan, completely liquid, so she could use it. And it also will increase a death benefit for the next generation.
Great point, Anthony. And that is also the answer that I will typically give when somebody's asking, hey, should I have one policy or two? How are we going to split this up? If we're a married couple, we typically always want to split that up. So great point. Hope you guys hope this was helpful for you. We gave you an overview of the 3 types of policies, some of the pros and cons, and then also some of the options that you'd have if you ever wanted to shut premiums off. So hopefully that was helpful for you.
And if you need some more clarification of these types of policies, or maybe you got a policy and you're not sure, can I do this for infinite banking or does it work? Hop on the discovery call. Mm-hmm. The link will be in there. No cost or obligation. You get on the phone with one of us and we're kind of talk about what you got and we can talk about what the appropriate next step is.
Awesome. Well done.
Well, thank you.
Yeah.
Go make it a fantastic day.
Take care.
Thanks for listening, and be sure to subscribe so you don't miss out on the next episode. Also, check out our website, infinitewealthconsultants.com, to find our podcast along with other additional resources.